I took my exact trading strategy, same win rate, same trade frequency, same risk management, and I ran it through the specific rule sets of 15 prop firms. Most of them I passed, but this wasn't the most interesting part. The interesting part was the funded survival rate and how likely I am to have the account after 6 months of trading. At 2% risk per trade, a lot of them had funded survival rates of 0. All right, so I'll briefly explain the strategy specifics on what kind of data that we're working with in this sample. So I had 541 trades from 2020 to 2025. This is with no Monday filter, which I'm going to explain in another video. Average win was about 2.2R, and I had partial loss and a full loss ranging from 0.5R to 1R as a full loss. Expectancy was about plus 0.3R per trade, and the frequency was about 1.5 trades per week. So these are real outcomes from 5 years of data, but most importantly, and one thing to note and to remember, is that 20% of these trading days had over 2 or more trades on the same day. Now that matters for things like daily loss limits, and we know prop firms nowadays have these quite tight daily loss limits, and I'll show you why that matters in a minute. So here's what I built: a Monte Carlo simulator that takes my real trade data, not the averages, but the actual distribution of outcomes, including the multi-trade days, and it runs it through each firm's complete rule set. It checks profit targets, static and trailing drawdowns, daily loss limits against the real total for each day. So I'm running this at 3 different risk levels. I'm going to do 0.75%, which is the conservative funded baseline, 1.5%, which is sort of where you're pushing a challenge, and then 2%, which is the more aggressive and where probably the most interesting things happen. So let's look at what comes out. So we can see at 0.75% risk, the headline is that pretty much everything passes. Everything's green. All 15 firms show that it's a viable option. But before you stop the video and assume it doesn't matter which firm you choose, let's look at 2 things here. So first is time. And you can see the medium time to pass phase 1 ranging from 7 weeks on the fastest firm to 19 weeks on the slowest. So at 0.75% risk and averaging 1.5 trades a week, you're going to be inside these challenges for a long time. And ultimately, like we spoke about in previous videos, time is a cost. Time is valuable here. What's interesting to see is these instant funding type evaluations where you basically skip the evaluation straight to funded. They inevitably have a trailing drawdown. And you can see the 6-month survival for these trailing drawdowns ranges from about 32 to 68%. So you can get in easy, but staying in and actually receiving consistent payouts is the difficult part. All right, so now let's see what happens when we put the risk per trade to 2%. And this is inevitably where the firms start to separate. The pass rates range from 80% all the way down to 41%. Same edge, but completely different outcomes. And look at the 6-month funded survival, how that just completely changes. Most of them have an incredibly low survival rate, and when you're risking 2% on a funded account, you're inevitably going to hit a string of losses, whether that's 4 or 5. That's your account gone. So this is inevitably the finding that should change how you view these prop firms. Everyone's focused on passing the challenges, but the challenge is not necessarily the hard part. The hard part is actually keeping the funded account. So these are inevitably the 3 killers when it comes to funded challenges. Now, as I've said before, 20% of my trades were 2 trades in 1 day, right? So if those are both 2 losses, that's minus 2R on 1 day. And at 2% risk, that's a 4% daily loss. Now, any firm with a 3% daily loss limit breaches instantly. That's not necessarily because it's a bad trade, but because that's simply how the strategy performs. Number 2 is the trailing drawdown. Trailing drawdown essentially means that your maximum drawdown tracks with the profit in the equity that you make in the account. And for a lower win rate system, this is structural poison because your equity curve is naturally going to cluster, where a few wins push it up and then the inevitable losing streak occurs. Now, trailing drawdowns essentially punish that shape and that style of strategy. At the funded stage with a trailing drawdown, the survival rate is going to be so incredibly low that you're going to have to risk a tiny amount to even keep the account. And when it comes to withdrawing meaningful payouts from that firm, it's very unlikely that you're going to see those. Third one is going from the challenge to the funded account trap. And a lot of people will take the same risk on the challenge as they do on the funded stage. And inevitably, that is going to drastically reduce the survivability of that account, because the challenge phase, you're not getting paid for. The only cost to you is the evaluation fee. Now, when you get to the funded stage, you are able to return profit on this account. You are able to withdraw a payout. So the goal is not necessarily to risk as much as possible to get to the profit stage as quickly as possible. It's to conserve the account and to draw reliable income from that account. So it's a combination of high risk in the evaluation phase and reducing your risk once you get to that funded stage to, number one, either secure a refund or to secure a payout. So here's what this data actually taught me. Picking a prop firm isn't just about reviews. It's not just about brand recognition or which YouTuber has an affiliate code for the prop firm. It's a 5 variable matching problem. Your win rate, your trade frequency, your R distribution, your risk level, and how long you plan to stay funded. For my specific strategy, the firms that work best for me have static drawdown, no time limits, and a daily buffer, a daily drawdown loss that can absorb a 2 losing streak in one singular day. So I use prop firm match to filter each firms by these exact parameters that I'm looking for. And when you go on the prop firm match website, you can go into this filter section. You can choose your maximum loss type, which is obviously static for me, the daily drawdown type, which inevitably I want to be balance based, and then any advanced filters that you want to have. So if you want minimum max daily loss, obviously for me has to be 5%. And then that way you can choose the firms that actually fit your strategy. I'll leave a link down below if you want to check out prop firm match.